Stocks have marched higher, but what about the economic outlook? Our senior economics reporter, Steve Liesman, joins us right now. He's got a rapid update with how things are going. Steve, good morning.
Good morning, Becky. Yeah, the economic outlook has brightened a bit, but it's not nearly as rosy as the market looks to be. Most forecasts still see tariff effects weakening growth and driving inflation higher, though both are somewhat less than they were in our prior forecasts. The average of 15 forecasts on the street in the CNBC Rapid update, up almost a percentage point for the second quarter to 2.5% from 1.6% in April. But growth, you can see there, that dip down is still weaker in the third and fourth quarters before it returns to trend by the beginning of 2026. The overall year outlook is 1.3%. That's the average, but there's a debate among forecasters about whether it will be the growth will come in at or below trend. You can see Action Economics and Goldman towards the top of our respondents there. Raymond James right in the middle. J.P. Morgan and Morgan Stanley, they're a little bit below trend towards that 1% area. Average core PCE inflation also came down for the second quarter with what looks to be an expectation of a delayed tariff impact, but it's forecast to shoot up in the third and fourth quarters back towards 3% before settling down next year. That remains a percentage point above. It fuels this debate we're having about whether the Fed should cut now or hold till those numbers start to come down. These forecasts could be off the mark again. They forecast weakness and recession in 2023 and 24. Didn't happen. Equity investors, well, maybe they're betting on better outcomes or differentiating, guys, among the stocks that will be hurt by tariffs and those that aren't. Unclear, Becky.
You know, Steve, earlier this morning we had Stephanie Link on, and she talked about the GDP we've actually seen in the first half, and probably the market's reflection, too, broad reflection, watching what's happening with markets today over the last week, over the last even several weeks. I mean, they seem to think that the economy is doing pretty good and that the market's going to be able to weather all of this because companies will be able to weather all of this.
Well, certainly we don't see recession in there. There were some negative numbers back in April, and even before, when those April 2nd tariffs came out, there was a lot more concern. People have backed off that. I mean, the idea being when you put up GDP numbers that are weaker towards 1%, the theory is that something's got to give in terms of tariffs. Now, I understand that there have been markdowns in the earnings outlook for tariff-affected companies, and it looks to some extent like the Mag 7 and some of the other tech companies are sort of overshadowing what's happening beneath. But again, I don't think we get out of this without any tariff impact. It looks like it will be a little less. And right now, if we get out of this with a couple quarters of weaker growth, I think that would be getting off cheap.
You think the Fed reacts more to weaker growth or inflation at that point?
Yes. I mean, those two charts there are precisely the Fed's dilemma. You get that weaker growth, but notice that inflation, if you could have put up that core PCE chart again, you'll see it remains relatively high. And I think they have to make that choice. If it looks like they can look through it, there it is. And they can, I mean, this is precisely what Powell's talking about. Every forecast on the street, we have 15 forecasts, you name it, they're part of this survey, and that's everybody sees it going up a little bit less than it was, but towards that 3% range. If they can feel confident of the backside of that forecast right there, that it does begin to come down into 2026, they could maybe cut a little bit in the back half of this year towards the fall, but I think they have to be confident it's coming down.